There we go. Okay. Welcome everybody to our 224th Wedding Online Sports Economics Seminar Series. It is a pleasure to have Danny Hill from Providence College speaking on sport as an alternative asset class, foundations and conceptual framework. Before he starts, I'm just going to say a couple of things. The usual, we are hosted kindly by the University of Reading and sponsored generously by the Sports Economics Review. Those of us that are here are not enjoying the e-case workshop in Rotterdam today, which looks like a great event, and there's a number of the normal contributors here are there today. But if you're not there, not able to enjoy Rotterdam, you can be here and you can enjoy this. On the topic of deadlines, conferences, etc. The deadline is tomorrow for the third workshop on sports, economics and natural experiments up at the University of Stirling, organised by Carl Singleton and Raphael Flepp. So do send an abstract in for that. And then there's the deadlines that are coming up in March are for the Athens University of Economics and Business Sports Analytics Workshop, and also the European Sports Economics Association Conference in Zurich. And then finally, on the 1st of April is the deadline for the 20th Sports Economics Conference in Gijón in Spain. So do look out for those. I'm also starting to fill up slots after Easter. So if you want to present in Roses and you know someone that wants to present a paper, let me know. There are slots available to fill from April 17th onwards. That's enough for me. Danny, all yours. Are you happy to take questions as you go along, or would you like people to hold them for the end?
Questions at the end if possible, but I appreciate if something's a burning issue, I'm happy to take questions as we go if someone needs anything.
Great, super. All yours.
So good morning, good afternoon, good evening, wherever you may be. Thank you for joining today for today's session. So my paper, sport as an alternative asset class. Just as a background to the paper, this is not an asset pricing model per se, it's a classification question. And it kind of stems from the story I'm going to say to you in a bit. But in sports economics, it's long been accepted and well established that sport is economically different, as James has obviously held for 224 sessions now. We all know that very much so in the sporting world. And every person in this room has contributed to the conversation. And by no means, if I did a reference list, could it be exhaustive. However, I started my role here back in August at Providence College in Rhode Island, and my colleague who is next door to me, Professor Maria Gonzalez, we were chatting in the corridor about our research, and I said the expression, I'm in sport finance, I research player valuation, and I said the sentence, sports an alternative asset. And she kind of looked at me with a tilt of the head, and I thought, oh, I've said something wrong here. And she went, sports an alternative asset? I suppose it is. And in that moment, I thought, well, one of us is wrong, and normally in these instances, it is always me. So I went away and started doing some reading. And in the financial aspect, it's not. There's no research literature that even begins to talk about sport being deemed an alternative asset by description. But we know, obviously, economically, the sport is distinct. So a question that then come to my mind was, does that distinctiveness manifest in the financial return space? And therefore, from a financial perspective, is sport a typical equity exposure, or does it actually satisfy empirical conditions required that of an alternative asset class? So the question that I kind of come up with in my panic after speaking to Maria and my reading was, do publicly listed sports satisfy the minimal empirical condition that requires to justify its classification as a distinct asset exposure? So essentially, it was building on Maria's kind of pause and look as if to say, when you work it through mentally, there is possibly an argument that it could be. So that's what I wanted to set out and try and find with this working paper. So first and foremost, what is an alternative asset in finance? It all begins with Markowitz back in 52 and the portfolio theory. And essentially what we find in that portfolio theory is assets that are added to the portfolio eventually can reduce the risk. So therefore, relatively, the risk return improves up until a point. And as we see on this particular chart here, the capital asset line, the tangential portfolio would be the optimum portfolio. So this is where we can get... Sorry.
Just you haven't shared your screen yet, so you can't see your slides.
Apologies.
So
sorry. That was my bad. I knew it was something I had to do. Is it on there now?
Got it there, yep.
Perfect. I apologise, everyone.
No worries.
So this is the tangency portfolio I was talking about. And as we can see here on the capital asset line, the red dot represents that portfolio that has the blend of assets that creates a risk reward return that is most efficient. So typically, assets we usually put into this portfolio being those of non-traditional, non-alternative or traditional assets, such as equities, stocks, fixed income, and cash. Everything else outside of those traditional assets will become alternative. That alternatives are traditionally characterized by low correlation to traditional asset classes. They have distinct risk exposures. They have portfolio efficiency contribution, and their factor of non-redundancy. So the things that price the risk in those assets is different from the other three traditional asset classes. So to begin, a minimal empirical classification of an asset or an alternative asset would be that they exhibit distinct statistical behavior. Now, there isn't any paper that kind of highlights what would be classified as an alternative asset. I've kind of extracted this from various sources. So the first condition that we found was distinct statistical behavior must be exhibited. The second would be it can't be spanned by standard risk factors. So risk factors that are already priced within those traditional assets would just mean that that particular asset class would be a derivation of that established asset. And they must improve the mean variance frontier. So we must see that adding this asset to a portfolio improves the tangency portfolio and therefore provides a form of return without given extra levels of risk. So it improves that efficient frontier. So in that first statistical condition, the first condition being distinct statistical behavior, the asset must exhibit dynamics that are economically distinct from existing exposures. And that comes from this research here again. Various authors have come with different ways of how we measure this and how we bring it all together. But essentially, if an asset's correlation matrix looks like a simple sector tilt, it's not a new asset class. So therefore, we have to see if the co-movement is orthogonal to traditional asset exposures. Therefore, an alternative asset classification becomes plausible. So we know in sports economics that sport operates under a different institutional logic. So if sport is indeed an alternative asset, we should expect that logic to manifest in the covariance space. So that becomes the first condition in the classification problem. The second condition is that it's not spanned by standard risk factors. So if an asset's returns are explained by price equity factors, it's then redundant. It cannot be an alternative asset. It's just simply a strand of that existing asset class. And that research comes from various authors about how different models were produced for how we can capture those risk factors. So within those models, the key statistic we're looking for is not alpha. We're not looking about the ultimate return relative to risk. What we are looking for is betas that are near zero. So the movement of that asset relative to the market is near zero. It doesn't move. It has no effect. The market is not affecting on the asset and vice versa. The second is a negligible R squared. These proven and tested pricing models do not capture those movements in this alternative asset. So therefore, exhibit different risk parameters. And that will be checked when we look at consistent loading patterns from the models we run. So then the asset would be stated that it's a non-linear combination of known price risk factors. So from the finance perspective, if sport loads with market size, value, or size or value, it then just becomes a normal known equity. If it doesn't load, it then represents a distinct process for generating returns. In simple terms, the risk factors that are captured by these models and captured by the market are not reflected in sport as an asset class. And the final condition is about improving that mean variance frontier. So if an asset class status requires economic contribution, it cannot just be a statistical oddity. So using Markowitz's work and then the preceding portfolio work, if the asset lies within the span of existing assets, the adding it will not shift the frontier. So that tangency portfolio will not change whether we add or remove sport as an asset class. So therefore, we need to expand the efficient frontier. And that will then provide incremental diversification benefit, which will allow for an economic contribution, not necessarily statistical. It's whether the asset changes investor opportunity. That's the whole purpose behind portfolio theory, and improving it is to improve the investor's perspective, not just purely finding a statistical gain. So in sports economics, we have known that it's well established that there is institutional uniqueness in sport. So the finance question then, is that uniqueness priced in a way that would alter a portfolio construction? Or is that price already being captured within other aspects of the mean variance frontier? So the empirical design that I come up with was to get these three conditions into three statistical tests. So the first condition is if sport correlations are near zero relative to global equities, bonds, real estate, and private equity, then its distributional properties differ materially from conditional assets, then sport is not behaving just as a sector tilt, and it will be not within the traditional beta space. So that's what we test in condition one. In condition two, if betas are negligible and the R squared is close to zero in standard asset pricing models, the sport returns are not spanned by known price risk factors. So in financial terms, sport is not a linear combination of existing equity premia. And the third condition, if adding sport materially increases the Sharpe ratio of the tangency portfolio, then it provides incremental diversification benefit and expands that mean variance frontier. So an asset that shifts the frontier cannot be redundant within the existing opportunity set of all other assets. So these tests implement the established asset pricing diagnostic theory, and then the framework is derived from the modern portfolio theory and factor spanning logic, and it's not from any sport specific assumption. So essentially, we're taking sport as the asset class and testing it against these known measures in finance. So the first thing I needed to do was invent sport as the asset class, so to speak. So it's constructed from 21 publicly listed firms. Now, I did have a strict set of criteria to an extent, but that was quite hard to actually put into practical terms. But the main part of the criteria was that the primary economic activity is that of a sport or a sports team. So the team itself could not be a lower down subsidiary of a much larger company. The primary economic activity of that company had to be that they were a sport or a team. And then if there was spin-offs from that, fine, but it had to be the primary focus. So once I had those 21 public teams from a global search, we then equally weighted all of those companies into a portfolio. All the data was derived from FactSet. We then converted everything into US dollars. And the main part was I didn't want to do any no backfilling. I didn't want to assume backwards down the time space to say, well, let's add in teams and work out what they may have been trading at. All the data comes from actual traded, sorry, I think pop on the screen. Actual traded data between 21 and 2025. Now, again, before testing started, this is a very small number of companies. It is a structural constraint of the sporting sector. There are only 21 teams. I didn't want to start softening the criteria because then it adds a lot of noise to the data. So I just had to accept that that's the only period, the number of teams we could have. The time period is very, very short, but I wanted to use a clean data window. I didn't want to get involved with the during the pandemic, where obviously all equities and all market data went off shift. And pre-2021, there was quite a few listing changes and there was constituents that were missing. So trying to get a clean data set where near enough all the teams were there, it starts adding more noise to the data. And as this is purely an investigative classification paper, it's not trying to provide an asset model, I was comfortable that just to start this empirical journey, we would have enough information here. So again, these would be the 21 constituents that were found. It's a mixture of teams, again, the Atlanta Braves baseball team, which span out of Liberty Media, the Brisbane Broncos, which is an Australian rugby league team. The vast majority left of those are football teams. We have Formula One as a sport captured. Madison Square Garden captures the New York Knicks and the New York Rangers. And then right at the bottom, we have Tico Holdings. I did include WWE. I know there is a lot of debate around it being sport or purely theatre. However, as it has UFC bundled together, I took it as both being sporting contributions. So these 21 companies create, in my view, a portfolio of asset class that I will then use to compare against other established benchmarks. So the first benchmark to assess whether sport behaves as distinctive asset was the global equities ACWI ticker. And this would be a proxy for broad global equity market risk, captures systemic risk market exposures across developed and emerging economies. The next group was the aggregate bonds, AGG, which is a proxy for investment grade fixed income, a form of debt, and represents duration risk and defensive allocation exposure. So again, most portfolios will have a combination of equities and debt as standard. The next was the PSP, which is listed private equity, and it's an ETF, an exchange traded fund that tracks publicly traded private equity firms. And this essentially captures exposure to leveraged, illiquid style return structures that are present within the public markets through the private equity offering. And the final was the VNQ, which is like a real estate investment trust or a REIT. And it's a proxy for commercial property exposure and represents income generated from real assets with tangible asset backing. And similar to the SCI, all these data were converted into US dollar denominated and aligned to the common calendar, and return to computed consistency across all assets to ensure comparability. Excuse me. So distributional properties. This is the first real consideration of the data. The SCI generates a higher average return than all the benchmark assets in the sample, but with volatility lower than global equities and materially lower than listed private equities and REITs, which is quite an interesting finding. The more important point, however, is that the SCI does not exhibit extreme tail behavior. So it is not a high volatility speculative exposure. However, distributional properties alone do not justify asset distinctiveness. The key diagnostic here will be in the correlation, which will provide much stronger evidence for the first condition of the classification. So here we have the correlation structure. With over 1,000 daily observations, even the very small correlations will be statistically significant. So the statistical significance is not the primary focus here. The relevant question here is the economic question of magnitude. Correlations that are between 0.01 and 0.02 are economically negligible in portfolio construction. So as we can see, the SCI correlates with global equities, bonds, REITs, and listed private equities. It is economically negligible. So the magnitudes are not just low equity correlations, they are close to zero. So if the SCI was just simply a niche equity sector or a variant of private equity or any other variant of established asset classes, we would expect to observe some materially positive co-movement. We don't. So this satisfies that first minimal empirical condition that there is a distinct covariance structure within sport as an asset class. So the second test is to move on from covariance to diagnostics. What may be causing these differences? So we looked at the CAPM beta, and as we can see, it's approximately 0.01. So therefore, the CAPM relative to the market explains none of the variation in the SCI, and as you can see, supported by the R squared of 0.0002. So in asset pricing terms, the diagnostic is not the alpha, but the explanatory power. The global market and the factors around it explains virtually nothing of the sport company index, the SCI. So when we think back to condition 2, if the SCI was just a sector tilt with equity markets, we would expect a meaningful market beta. So a beta that looks as if these group of companies move with the market. We do not observe that in this test. But the thing that we need to consider is there may be other things in the loadings of the returns that could be determining why there's not movement. So for that, we looked at the Farmer French 5-factor model, which covers some of those factors. So when we add size, value, profitability, and investment, we check now, does the picture materially change? So the market risk-free, we can see that the market excess return on the broad market portfolios minus the risk-free rate, and it captures the systematic risk. The SMB is a small minus big, and return difference between the small cap and the large cap stocks. So this seeks to capture size related return premia. HML is high minus low, and it's a return difference between high book to market value stocks and low book to market value growth stocks. So we start to get both ends of the market spectrum. RMW is robust minus weak, and it's a return difference between firms with high operating profitability and low profitability. And this captures profitability related premium. And then CMA is conservative minus aggressive. So it's the return differences between firms that invest conservatively and those that invest aggressively. And it captures investment related premium. So if we think about sport and as an asset, they would somewhere fit within those diagnostic patterns. The small minus big, the high minus low, or the return minus the robust minus weak. We know that sports teams invariably are highly loss making, they're highly irregular in their makeup and their structure. So if sport was just like any other asset class within the 5-factor model, we should be seeing similarities. As we can see, the R squared is 0.0002, and that remains economically negligible, similar to the CAPM model. So we can see there is no consistent loading pattern that emerges across the factors. So for that, we then interpret this as the SCI returns are not spanned by the standard equity premia, and we link this back to condition 2. This satisfies that the minimal empirical condition, namely that the SVI, is not explained by known priced risk factors. So when we consider the market risk return, the factors that are driving the risk in sport do not manifest in the factors that are driving the risk in the market. So this distinctiveness is not sufficient unless we can consider economic consequence. And that is where we bring in condition 3. So condition 3 is where we look back to that tangency portfolio with the red dot on the line. And when we add SCI as a portfolio to that tangency, do we actually see an economic improvement in the returns of a portfolio? So when the SCI is added to a diversified portfolio, including global equities, bonds, private equities, and real estate, all those proxies we used in the testing, the tangency Sharpe ratio does increase materially, and the improvement is economically meaningful. So this is not about just abnormal performance, it is improving the portfolio's efficiency for a given level of risk, and therefore expected return increases, or equivalently, if a given expected return, the risk declines. So as an asset, or if sport is an asset, the shift in the mean frontier is not redundant. So therefore, the SCI provides an incremental diversification benefit. So an interim synthesis at this point, I just want to make sure that we obviously have a claim here. The evidence shows that the SCI satisfies these minimal empirical conditions required for asset class distinctiveness. It has low covariance, non-spanning by standard factors, and a frontier expansion. But satisfying minimum empirical thresholds is not the same thing as proving structural causality. There are several reasons why I proceed here with caution. First is the sample constraint. The universe of publicly listed sport organisations is small. Although this is a structural constraint of the sector, it does create methodological issues, and it does limit those cross-sectional power. So that's one kind of key limitation. The second is time horizon. I have only looked from 21 to 25. And again, I chose deliberately to avoid the COVID contamination and shifting away from the noise that would have been introduced from that data. And pre-2021, because of the different structures of the portfolio, it meant that there was a lot of shifting around of the portfolio again, so it doesn't create a long time horizon. Third, we are looking at public markets only. So the problem with sport is that most transactions occur in the private markets, and the SCI captures only the public ownership structures. So whether the private valuations exhibit similar properties, it remains an open question. And fourth is factor specification. I have tested standard equity factors, and sport price performance may be influenced by macroeconomic or institutional risk factors that are not included here. The absence of loading in CAPM and the family French models does not imply factor immunity, but it implies that there's non-spanning by conventional equity premia. And then the fifth is the mechanism is not yet modelled. So what I haven't done in this paper is construct a structural model of competitive uncertainty or institutional independence or regulatory constraint, but it does demonstrate orthogonality and the mechanism, but not the economic mechanism behind it. So at this stage, I'm not claiming that sport is definitely an alternative asset class in the same sense as private equity, hedge funds, or REITs, but I'm claiming that there is enough empirical minimum conditions met to justify treating the distinctiveness of alternative exposure and to motivate further asset pricing research. So this paper essentially at this stage opens the door, and it does not close any classification debate. One of the things I did start to look beyond when I was looking at the data was looking at this notion of seasonality. and seeing, well, was some of this driven by the fact that we have in-season performance and out-of-season performance, and therefore was that volatility or the differences being captured in the season when the performance is going on, and outside of the season it then goes flat, which created that misalignment with the market. So I did an ad hoc bridge just to look at the competition and seasonality. So this test bridges back to the mechanism about how sport, we know that there are seasonal effects in sport. I was wondering whether this had an effect or had any of the reason behind some of the findings I saw. So if competitive uncertainty is economically meaningful, the volatility should increase when the competition is active. So i.e. when we're in season, we should be seeing more volatility. And when we're out of season, we should be seeing less. So in the full SCI model, the in-season coefficient is positive, but statistically insignificant once market volatility is included. So broad equity volatility explains more variation aggregate in the SCI volatility than seasonality. So the interpretation here needs to be a little bit careful. This is quite a coarse test, and it operates on a monthly schedule with aggregate data across multiple clubs and multiple sports. But it did provide me still an idea of, well, we know that the vast majority of those 21 clubs in the SCI were football-based. So I then ran the test again, looking only at the football-based companies. So when we restricted the football-based equities, again, we did not see any material difference between seasonality. So even though when the season is playing and we have more information coming in, the models didn't necessarily show any more volatility or variation to that what we already saw. The only club, however, that did exhibit meaningful sensitivity to market movement was Manchester United. So the output across the sector, the market betas are overwhelmingly small, as we can see in column 1, and are all statistically insignificant R-squared values close to 0. But Manchester United, we see right at the bottom, exhibits sensitivity to global equity markets with a beta of 0.69 approximately. So it does, in essence, reinforce the earlier index level result that sport as an asset class does behave differently. When we look at individual assets within that class, such as Manchester United, it does start to show a closer alignment to traditional equity movements or market equity movements. But whatever is driving these stocks, we know it's not conventional equity beta. And this final chart here just kind of shows that example of how much extent Manchester United stands apart from the rest of the clubs when it comes to sensitivity to global markets. And this again is only included just to reinforce the earlier visual aspects that we spoke about. So limitations, again, primarily structural. We know that there is a small universe of publicly available listed companies, and there was COVID distortion that affected pre and post 2021 window. And it's pretty much impossible to avoid that weakness. We know with a lot of the clubs, there's also thin liquidity. Not all clubs trade frequently. So therefore, the quality of the data from those smaller teams is obviously limited. But what I do hope is, given the amount of investment from private equity into sport, the traditional exit strategy from private equity is to list companies publicly. So my view is, as more clubs may become public, or we get more information as clubs become more invested, we can start to test some of these assumptions or some of these hypotheses that stem from this paper. So for that, I just wanted to clarify a few things. What this paper doesn't do, it does not estimate a structural model. It does not claim a persistent alpha difference between sport as an asset class and other traditional and non-traditional asset classes. I haven't tested any macro shocks. So again, COVID would have provided a macro shock. But I wanted to test first, is there enough of a difference to even warrant that further investigation? And it doesn't integrate private market valuations. So we know most of the sales of sports organisations, sports teams, happens in the private market. And again, that information is not included here because there is no publicly available data to include. Having said that, what does this paper then actually do? It does establish a transparent and replicable benchmark for publicly listed sports. It does provide somewhere where we can say, how does sport behave, or what is the beta used in sport that we can provide in, say, off-market CAPM models. It does provide that. It does implement a standard asset pricing diagnostic to evaluate classification of sport as an alternative asset. It demonstrates and satisfies a minimum empirical condition for distinctiveness. And it shows that sport does expand the mean variance frontier in its diversified portfolio. So one of the things I keep reading in media, and especially with this drive of private equity in sport is a diversified asset. That is why people should invest in it. There was no empirical evidence that even suggested that. This paper does provide some evidence that sport does create a diversified opportunity in portfolio construction. And it provides us with an empirical foundation for future structural modelling. And it does open, hopefully, a research agenda with that intersection of sports economics and asset pricing. So some implications for finance, assuming the SCI covers the distinctness. The question we now ask is if the factors that are pricing standard equities and other non-alternative assets, those factors are not captured in sport, what factors are pricing sport? What are the factors that are actually affecting those share price movements of sport? If uncertainty in itself is a price stated variable, so we saw with the in-season, out-season ad hoc test, where the variance in the share prices didn't necessarily move between in-season and out of season. So therefore, does that competitive uncertainty manifest in a price stating variable? Does institutional design alter covariance structure? So we looked at football as an entity, and with the new regulator coming through and certain institutional design is going to change, do we ever see changes in that return space for sport as an asset class? And does the joint production industries create orthogonal return processes? So there's very few joint production industries that we can actually test. So we can start to test those in sport, providing those differences. And this is where, for me, obviously, I appreciate this is not an economics-led paper, but James has provided a fantastic forum for me to get my research out. So how does this blend back into the sports economic community and why it becomes important moving forward? So before I do that, I've just forgot I put another slide in. In condition 3, I did speak about how we frame it verbally. So when we look at classification processes, we know that the SCI is orthogonal to traditional equity risk, not spanned by standard factors. And in alternative asset theory, as discussed in condition 3, asset classes are distinguished by mechanisms through which they generate returns. So we know that hedge funds monetize inefficiency. Private equity monetizes control. Real estate monetizes scarcity. So if sport is empirically distinct, and we think back to condition 3, the question becomes, what is sport monetizing? So the thing that I come up with here, and again, something I'd love to get some feedback on from everyone in the room, is that sport monetizes institutional uncertainty. Competitive unpredictability then becomes the product. So this does not yet constitute a structural pricing model, but as I hopefully push this research forward, a question I will undoubtedly face is, what is sport pricing, or what is it capturing as the price return? So institutional uncertainty was one of the things I felt that sport monetizes. So if we know that the SCI does not explain standard equity pricing factors, what does? So when we think of possible direction, we looked at revenue volatility, competitive outcome surprises, regulatory intervention, media rights, cycle exposure, salary cap, financial fair play constraints. This moves then the non-spanning mechanism from identification into price driving. So one of the things I looked at was higher frequency event studies potentially becoming forward. I looked at monthly aggregation of prices, but future work could examine a much more granular match outcome, playoff qualification, relegation probability, managerial changes, player transfer announcements. All of these particular aspects, do they have an effect on the equities pricing? When we look at how the regime dependence changes, we're looking at how the new regulator coming in, or how the structure of sport could change. Does that have an effect on returns behaviour? We could look at macro stress tested, crisis sub-periods, volatility regimes, liquidity shocks, and correlation breakdown. What are the aspects underpinning those aspects in this particular paper? And then we move into the public-private equity valuation section, and that as most transactions occur in the private market, does this have a translation into the public market? But there's lots of areas here that we could expand into, and yeah, I appreciate that. Again, this is largely an economic audience, but my view here is I'd love to get some feedback on those aspects for how I can again improve this paper. So I thank you for your time, and obviously I welcome any questions you guys may have.
Perfect. Thank you very much, Danny. I will give you a team's round of applause. And yeah, thank you for a really interesting talk. And we've got lots of time for questions and comments. If anyone has any, please do raise your hand. Stefan.
Hi, Danny.
Hi, Stefan.
It's a really interesting subject, and there are a couple of things I wanted to say, which is sort of well, just first a couple of observations. So you said there's no literature on this, but actually there's been an awful lot written about stock market returns and sports assets, particularly football clubs. So I don't know. And I get that you're saying that that's not specifically addressing the question of whether it's a distinct asset class, but nonetheless, I think that is relevant background literature. And one paper I'd like to alert you to, because I think it's really important, and something I'm writing about at the moment with Richard Evans, is there's a really interesting paper in 1985 by Dempsitz and Lane, and what they did is they were looking at whether there was any difference in um, corporate ownership structures depending on asset types. And Dempsey's had this very strong view that there would be no systematic correlation. Essentially, management would always just adjust to whatever was optimal for the firm. And he claimed to find evidence to support that. But what they did in that paper say was that sports were different. Is that they found concentrated ownership in sports related enterprises and sport and media. And the reason for that, they argued, and the value there, and this is, I think, is probably relevant to why this asset class might be of value to people, is the amenity value, what they called amenity value, that owners get from concentrated ownership. And I think that's one of the things you do see with sports assets. They tend to be controlled by single individuals or families because the prestige and kudos. And that's not a direct financial return. It's a sort of it's an indirect return. And so I think that's something you should maybe address. Because the other thing I wanted to say though is really and really this sort of might finally maybe a question, which is as you say, you have a very short time span here. I'm sure you're aware that in the mid-90s, there was something like 30 football clubs across Europe that floated on stock markets.
Yeah.
And apart from the few that are still in your data, they all died.
Yep.
And so they generated zero long-term returns. So is there a problem with your time span? Is that you've sort of ignored all of that chaos that was of the previous 2 decades with your time frame, and if you took that into account, I think it fails your condition 3 that they have to be add to returns. If you'd invested in football, added that to your portfolio in 1995, it would have been a total catastrophe for your portfolio, and you would never have wanted to do it. So I don't know how you factor that into your analysis, because I don't think you can just ignore it, right?
No. So I completely agree. So back to your first point about those other, I meant more from just the distinct asset pricing theory, as in the alternative asset classing theory, literature-wise. I know there's obviously lots of papers that do speak about sporting returns and assets. So yeah, I apologise if I made it seem as if there was none in that respect. It's more purely about this alternative asset class we always read that sport is assumed to be. I did look at the data from back, again, what data was available. And again, it's one of those considerations I had about building it in. The only reason why I didn't go as far back was just because I'm looking at kind of current world moving back. And when I started looking at all those other sort of assets around everything else, it become not necessarily something that wasn't warranting review. It was more how I get this view that this portfolio of different clubs equally weighted over the period of time, the clubs falling in and out of it naturally created more noise. So I just wanted to test one set of portfolio where there was very little ins and outs of clubs from all different sports. So that there was an idea of, is it just the fact of there's lots of movement in and out of the portfolio that's creating the noise or the differences? Or is it purely just the fact that we have a set of clubs here, one portfolio, there's no exit and entry in that portfolio. So therefore, any other noise about those coming in and those going out is not explained by this constant change of the portfolio. That was the reason why I picked this very small window of time. And again, that's why I'm stressing this, not here to say that there's enough here to classify it as an alternative asset, but it's more about having a conversation on what we read a lot in the media, that sport is an alternative asset. It is a good place for people to put their money to diversify. It was more considering that question, but there is certainly in my mind, looking back over the, again, my father bought shares in our team in Millwall, which turned into
ouch.
Exactly. Not only was it bad for the club, it was bad for everyone. So I am familiar with that period of time, and it is something that I was looking at building forward from. So I certainly haven't ignored it in this respect. It was more just trying to find a window of time where we looked at.
Well, sorry, can I just push back on that? You said it's noise. It's not noise. These are systematic negative returns. It's not random. It's not up and down. It's down, 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 down. Losing money.
Sorry, because
So
eventually the portfolio then
football clubs is a way
streams.
to lose money, right?
No. I'm not suggesting that by having these in the portfolio that the individual assets are going to generate individual returns. It's purely from this portfolio perspective. And when I went back to the data set that I had from FactSet, the information only included the teams that are still around. So with the data set that I had, it didn't have the teams coming in and the teams going out. I looked at it from those that are currently available now backwards. And again, it was just a top-down approach rather than a bottom-up approach. So it's certainly something I will go away and put in to see if the changes are materially different.
Yeah, maybe Dennis could join in, because I'll come back in a minute. Let's see what Dennis has to say.
Thanks for the talk. I think I'm a little bit like Stefan. I'm not quite sure what we're talking about here. Why does it? So the bottom line for me, and I've got other sub questions, but the bottom line for me is, why do we care if sport is an asset class as opposed to looking at the individual stocks to the extent that there are enough to do anything? And part of what leads me to that is I think, had a slide that said we want to look at what are the factors that determine the returns on this asset class. And then it sounded like you said a bunch of things that are already in the literature. So we know surprising outcomes or changes in managers and stuff like that from the existing literature affect the stocks of individual clubs. So I'm not sure what the benefit is of deciding this as an asset class versus we're just interested in the individual stock.
It's mainly because of the way that when you read in a media setting and about investment, they talk about sport being an alternative asset class. And it's when I just said that sentence to my colleague and she sort of looked at me a bit quizzical, is there is a notion of belief that sport is an alternative asset class. You see it every day in the media. People invest in sport because it's an alternative asset class. The question I just asked was, is it? Because individual companies, people do invest in, but so people will tend to invest in asset classes. So people will invest in real estate as an asset class, not necessarily go and buy a particular building. They may investigate in a portfolio of assets to capture all of that difference within that group of assets. So essentially the question wasn't looking at which individual clubs are affected by which individual aspects. It's more as a collective group of companies in sport, in football, especially largely loss making, how does that actually work in a portfolio setting? So I wasn't looking at the question of individual returns from individual movements. It's purely, does a manager change in one of those 21 constituent clubs have an effect on the portfolio? Rather than does it have an effect on the specific share, is the kind of approach that I was coming from.
Okay. I still don't understand, but I'll turn it back to Stefan or anybody else who wants to ask a question.
No, we can tag team on this, I think. I mean, so what, I mean, one obvious question is, did you try this with just the football clubs? Because obviously the majority of the assets are football clubs, but you have some pretty big and very successful, like Liberty Media. I mean, wow, whoa, that one asset alone would probably been a really good idea to invest in 2021, right? And
Yeah.
probably actually forget everything else. That's probably the one that would have made you money. So if you take that out and you just look at the football clubs, what do you get?
So I looked at the seasonality aspects. So that slide about looking at just the football clubs and does the seasonality volatility change, and it did keep it as distinctive enough that it would not follow market returns. So the market returns of just the football clubs was not seen, as in the return of the SCI portfolio of just the football teams did not mirror the same market returns that we observe with the other four asset classes that I used. So it showed material difference with just the football teams as well. And I checked for that. Was that because of the seasonality? Is it because in season it's much more volatile than out of season it's less volatile? To check is that's what's creating the difference between the two across the 12-month calendar period. And the seasonality had little to no effect, barring with Manchester United was the only one that seemed to follow more of a global equities pattern than the other teams in that just football club portfolio.
But also, I would have expected the returns on the football clubs relative to the non-football assets in your class, they would have been much lower, right? Surely they were ratcheting up much lower gains. I mean, maybe I'm wrong, but I just have a feeling that Liberty Media must have exploded in value because Formula One's been such a huge success.
Yeah, so we had the Atlanta Braves spin-off from Liberty Media in there as well, plus the Formula One spin-off from Liberty Media as well. With just the football teams, it's more along the lines of the difference in what those teams collectively returned, not as an individual dividend paying stocks, but purely the share price return. The football teams did exhibit returns not explained by the risk factors of the market or REITs or bonds or those other three classes. So there was a difference in returns. And again, the question I'm asking is what was explaining those differences? That's the question I haven't been able to answer. It's just acknowledging that the returns and the risks seen in those other three asset classes were not seen as the drivers of the returns in sport. So it's just classifying the distinctive difference between what's driving then the share price returns in sport. If it's not the returns we're seeing in the market, that's the kind of question that I ended it with.
Yeah, you see, I think in some sense, probably the problem that's bothering me, and I think probably bothering Dennis as well, it's not the question that you're trying to answer, which I understand that, but it does seem to me it is the fundamental question, which is, somebody comes up to me and says, Stefan, you know about football finance. I've been told, based on a study of returns from 2021 to 2025, that this would be a good investment because it has characteristics that make it a distinct asset class, and adding it to my portfolio will improve its efficiency. To which I would then say, without being able to refute any of that directly, what I would say is, oh my God, never invest in football. It's a hopeless investment. It's a proven hopeless investment, and the only reason that this looks like an attractive asset class is it ignores entirely the previous 2 decades of disaster and collapse. So that's the problem. So what do you say? How do you think? Is that a fair critique of what you're saying, or is it still beside the point and not relevant?
No, the point is entirely relevant. Again, that's my problem with the limitations of my very short window of time. So when I do, again, look to sort of go from a bottom-up perspective, this is still a working paper. In no means is it something that's a done deal, and this is why I reached out today to get this kind of feedback. I would say that what the paper is showing is that it adds diversification benefits. And that's what the efficient portfolio is designed to do. If you've got more diversification, you can obtain a different risk reward profile. It improves that tangency portfolio. That's the kind of what we've found in the paper. There's not really necessarily, if you invest your whole portfolio in sport, it'd be a very, very stupid investment in my opinion. based on the things you've said.
Yeah, we agreed on that.
But it's essentially, it's that when we consider it to the pricing factors of other asset classes, the explanations of what drives the other asset classes is not explaining what drives sport. I'm not saying that you'd invest in sport. I'm not saying this paper's not trying to say you should invest in sport. It's, well, what's driving the differences in sport asset classes? If it's not what's already captured in the market, if it's not what's already captured in the real estate trust, or it's captured in private equity or attracted in bonds, what is driving the risk, or what is driving the risk return profile in sport if it's not the things that are driving it in the market? So therefore, is sport then an alternative to those other four classes? And in this very, very small empirical stage, it appears distinct. Now, whether that then revolves into I'm going to invest in it is not the question, because again, you'd need to do a pricing model for that, and that's something that I've not even gone near with this. It's purely that original question of, we assume sport is alternative asset. From a portfolio perspective, is it? Well, it appears that it is. That's essentially as far as I've got at this stage.
Yeah, but you know that if suddenly this is declared publicly to be an alternative asset class, investors will pile in to this. There will be a flood of investment. So in some sense, it's not quite right to say that you're not concerned about whether people would invest in it. I mean, in some sense, the whole purpose of this paper is to justify this as a separate asset class, which then leads to the next step of let's model it on the market and let
we've priced, and actually once we've been able to build a pricing model, that's when that question, I'd say, becomes more relevant. So if it's an alternative asset class, we then need to find an alternative pricing model. But until we can see if it's not, again, that's something that I've not.
Well, could you explain that? I don't quite. So I'm not sure I understand that. If it adds to the efficiency of my portfolio, then I should invest in it, right? A well-diversified portfolio that should include this asset class. Isn't that right? That's the logical conclusion. So it's not saying it's not. So in that sense, it is saying the results of your paper are to say, yes, people should invest in this.
It would improve a diversified portfolio, is what it is suggesting.
Well, who doesn't want to improve a diversified portfolio?
No. That's the part. But what I'm saying is, I don't want it to be a case of you look at sport as a whole, one investment class. No, it needs to be in a diversified portfolio.
No. I assumed that. I mean,
sorry.
I thought that was sort of base ground rules. You wouldn't put all of your money into sport.
Sorry. Okay, fine.
I wouldn't put any of my money into sport. I mean, that's the question. Should you even put any of your money in? And I would say my take is the history of the last 25 years is to say, not on your Nelly. That's madness. It's a surefire way to lose your shirt. And you're saying, based on the last 5 years, oh no, actually you could do this. And I think that's the tension that I sense in what you're doing. But I was just curious. You were saying that you're not moving on to a pricing model, and I think I just don't understand that. So what do you mean when you say I haven't moved on to a pricing model, or the next step is to move on to a pricing model? What does that mean in practice?
So when we think about a pricing model in the sense of, well, what is driving the risk return, as in what factors of risk are we capturing? We saw in the Farmer French model that the typical factors that we look in equities are not being mirrored in sport. We then look at it in the CAPM perspective, the things that drive the returns in the market are not being captured in sport. So the question then we look at is, well, what are the risk factors? What do we measure to assess what we think the return of a sporting asset would be? I don't know what those risk drivers are, but what we're saying is, compared to the other asset classes, it doesn't appear to mirror those risk capturing premiums. So then what is the risk capturing premium in sport that's driving the share price? Because it isn't traditional movements of the market, and it's not the traditional factors that are moving the market. So what is moving the share price in sport? I haven't looked into that in any depth yet, because that's a kind of a next step. I've just looked at it as if sport wasn't distinctive enough to compare as an alternative asset, you'd bundle it in with a 5-factor model or with a CAPM model, because you assume that all those things are capturing it anyway. What we're saying is those things are not capturing the return movement of sport. So what is? I haven't got that far yet in my research.
So, right, I think I understand. So I think what you're saying is, so basically to do that, what you would do is you would run a regression of the returns on the market, and then you would add in other factors into the regression, and if they were statistically significant, they would be considered sort of explanatory factors for. Yeah, right,
Yes.
right. What do you
So
call
under
that?
current,
There's a name for that, right? That's that type of model. It's not CAPM. It's what do you call it?
The factor model.
Factor model. Is that right? Is
yeah.
it just a factor?
So again, so under the established the French family 5-factor model, those factors are not capturing the return in sport. So those factors are not mirrored. So therefore, I'm not saying what is capturing it, but we're saying that under the traditional pricing models, they're not capturing enough to explain the returns in sport. So the next step would be, well, what is capturing the price returns in sport? Again, that's something I haven't crossed yet. This is still very early stage, but it's more to justify whether I'd even look into doing a pricing model is, well, how do I know that it's not captured by the current pricing models? This is what this paper kind of looks at.
Can I jump in here? So I think I maybe missed this or have forgotten it as the discussion has unfolded. But you explained the returns on each of those existing asset classes, and the same things that explain those don't explain sports. That's what you've just been saying.
Yeah.
Okay. So your sport, basically what you've done is constructed a sports portfolio index.
Yeah.
And you're comparing the returns to that, or the determinants of the returns on that index with the returns on other indices.
Yeah.
Okay. You have 20 companies?
21 is the current trading that meet the criteria of their primary economic function is that of a sport or a sports team.
And how many would be in any of the others?
Oh, again, that's what I said to you. There's very thin trading, very low numbers. The others would have hundreds.
Yeah, and so I'm wondering if some of the explanation has to do. So you said it, and I'm just coming around to understanding it. Some of this explanation may simply be that these 21 assets, individual assets, when I index them in this equally weighted format, just don't contain the information that those other indices with hundreds of assets in them might contain.
So in the limitation I mentioned, the thin trading could be a reason for it. It could just be the fact of that some are on exchanges where there's much lower market trading. The 21 itself could not be enough to possibly, but it's more of a case of looking at current traded companies. There's only 21 of them. And that's why I said I'm very cautious on what this actually says going forward. It's purely because of the conversation where it was sport is assumed an alternative asset class. My colleague was, is it? And it just started an idea for me to go and research into. But I'm very trying to constrain back to, I'm not saying that this would be something we should plough forward with, but with the information that I currently have, it appears to the sentence is sport alternative asset class. It appears it, yeah.
And I guess this goes back to my original question is, so what? Because, I mean, unless somebody's portfolio is entirely made up of these indices, and I suppose it could be, they would be more interested in what are the returns on the individual stocks, I would think.
In portfolio theory, they try and push it to be the collection of types of assets rather than the individual level of stock, because the diversification comes from having all different asset classes in your portfolio. So at the headline level, rather than buying individual stocks, you'd buy an ETF that captures the movement of all the other stocks within that ETF. So the SCI's 21 becomes a unit of that other more diversified portfolio. And what it shows, if you include all 21 clubs equally weighted, it improves the tangency of the portfolio.
I'd be curious what happens if you didn't include them equally weighted, but you included them individually. And I think this kind of comes back to Stefan's point about Liberty. It's enormous, and it may be that's driving all of the result.
I only had the Atlanta Braves in there. So it's not Liberty Media itself, it's Atlanta Braves trading and Formula One's trading stocks. It's not Liberty Media. Again, so because they have economically distinct stock tickers and trading, Liberty Media as a whole is not actually in the portfolio. It's the Atlanta Braves and Formula One's
Okay.
individual traded stock. Madison Square Garden's the only amalgamated one because the Knicks and the Rangers and MSG are under one umbrella. But I felt there was enough economic driving from those two clubs to justify that they are the primary economic variable of MSGS.
But again, it could be all F1 though, right? I mean, F1 it's just exploded in this period, right? The growth has been phenomenal, right?
And in reading it, they talk about it being this private equity boom into it and then spinning it off onto the market. So at the moment, there's this view that all this private equity coming into sport and then being spun onto the public market is going to create this boom. Again, I don't know whether it will or it won't, but at the moment, if you had an equally weighted portfolio of all globally listed sports, it appears to improve the efficient frontier of the portfolio.
But setting aside the last 5 years, we have more than 100 years of data showing that football clubs systematically lose money. So it just seems like an odd proposition that after 100 years of this total failure in everywhere and every place at all times to make money, suddenly it's changed. I mean, this just sounds like a formula. I mean, the money going into private equity seems crazy to me. I can't explain it. It seems like guaranteed to lose money. But I certainly get the appeal to private equity of then foisting it off onto public markets, saying, oh, look, here's a new asset class, invest in this. But that's just going to pass the losses on to somebody else, isn't it?
And the thing is with Formula One, it was a huge loss-making entity until Liberty Media got hold of it and turned it profitable. And I think that's the view in the private equity market, especially, it's kind of being carried forward. We're going to improve it, we're going to make it profitable, and you're going to benefit from it, is the story. And again, do I personally have sport in my portfolio? No. But it's more because that common statement of sport having an alternative status. I just wanted to check if that was actually something that had any validity, had held any water. And from the research, it appears it does. But then what's pricing that? No idea at the moment. Why is it changing? No idea. How much is being driven by a handful of those? Because it's equally weighted. Again, I didn't look at it as a float adjusted weight or a cap weighted. That might be something that I could possibly go away and do and see if it dramatically changes. And again, Manchester United's results that come out yesterday, which were appalling, has seemed to have negligible effect. So is the market just accepting its loss making, but they're going to get returns on the share price? And this, again, these are the things I don't know. It's just more the question about it being an alternative asset. Is it, well, apparently, according to this data, it appears that it provides enough distinction from traditional pricing models and the way we look at other assets that it is unique. And again, that's where it comes from the view of the sports economics. But we know sport is unique. So how is this manifesting into this return space? Well, at the moment, I don't know, but I know I can say that it certainly provides a difference or a diversification aspect to any typical portfolio.
So one question would be this. So just hypothetically, would you just imagine for me that you had not 5 years of data, but 25 years of data? So that would include your, Millwalls and Nottingham Forest and all of the failed flotations. Leicester City had one actually, but long before they won the Premier League, they went bust, having been floated on the market. So there's these 20, 30 flotations in the mid 90s, and just imagine for me that they're in the data. And what we know happens is these stocks dramatically underperform the market, and then they vanish from the portfolios as they go bust.
Yep.
That's what happens. What would that look like in terms if you applied the same modeling that you applied to your 5 years of data? How would it look if you applied it to that 25?
If we just stuck to football, I would assume that it would be horrendous. It would certainly demonstrate different market returns to the market. But the market returns because collectively football is a horrendous investment. So therefore, relative to the market, it would provide a difference in how a portfolio will be constructed.
How would it affect? Which of your three conditions would it affect? That's my question, right? Because you had these three conditions for being a separate asset class. So how would it affect each of those three conditions? Would you say?
Mainly on condition 2, when we start looking at the Farmer French and the CAP-M one, I think it would meet that just because it was such a bad investment. It acted so differently to the market that it would appear statistically different to the rest of the market. So it probably, again, not saying different for the right reasons, but certainly different that the rest of the market went in one direction and football went in the other. So therefore, is it distinctly different? Yes. From these other pricing models. Right. But it probably wouldn't meet condition 2 in condition 3 that it improves the mean variance frontier, because the risk would have been so much higher and the return would have been so much lower that it probably would have not met condition 3 if we just looked at football from the 90s. But in the 90s, I'm not too sure other sports that may have been around that could have carried on an equally weighted portfolio. And again, I'm just saying that side of it.
No. It was an unmitigated disaster that couldn't be avoided. Apart from realizing you just had to know that there was no way to make money in this, right?
Yeah.
Because the economic conditions do not enable football clubs to make money. And that's just
no. So I mean, other sports, again, I wasn't overly aware. I'm going to still push. I'm going to keep obviously looking into this because it's going to become something that I find interesting. But I wasn't aware of any that the American sports that may have been listed in the 90s. And again, looking at a global portfolio of all sport, if we looked at just football, it would certainly violate condition 3 in that it wouldn't improve the mean variance frontier. Global sport with all companies equally weighted across the 90s and the 2000s, I don't know if there would have violated condition 3, because again, you could have had a Liberty Media, so to speak, then an equally weighted portfolio carried enough through. We don't know what stock's going to be good and bad in the portfolio, but we buy all of them to assume that we're going to improve as an average. And as long as we're carrying an improvement in that risk return.
Yeah. No, I mean, the problem with the US is there weren't any listed, there've never been any listed clubs. So you can't do that. But what Dempsey and Len did, and that's why I think we should look at them. Sorry?
Yes, there were.
Well, not many, right? Hardly any.
Not maybe half a dozen.
That many?
Yeah, the Celtics and the Florida Panthers, maybe not half a dozen, but 3 or more.
2.
Well, that's 2. But I know there's more than that. Those are the 2 that are coming to mind.
Okay, so but really that's not enough to do a portfolio analysis on. I think that's the problem. But what Dempsey and Len said was that they found that the listed companies that were very similar that looked very similar to sports in their mind were media corporations. And again, their argument is that people own media corporations for the same kind of amenity value, the prestige, the Rupert Murdoch kind of power trip that he's on, right? That kind of thing, it leads to concentration of ownership in media corporations, and that's similar to the concentration of sports. So you could think of that in parallel and say, well, our media, good question is, are media assets, are they a separate asset class because they have this distinct amenity value property, which is, I would say, is what I think Dempsey and Len are right about. That's the key focus, right? That's the thing that really distinguishes them. It's the glory.
Yeah. Essentially, the record label, when you have the superstar, that's what everyone wants to have. So it does. So no, but again, that's the thing. It's it's more of the case of just intriguing that conversation I had with a colleague. And again, I read it all the time. Everyone's investing because it's an alternative asset class. I just wanted to investigate, was there any basis to that statement that it is or it isn't? And at this stage, there is a basis to say that there could be. But again, all the limitations are there in that it's not something we could run ahead and say that it most certainly is. My next step would be, though, if I get the data, was just to see, is there a pricing model that can be derived from this that can start to explain why it doesn't follow the same patterns as the other asset classes, because that could then open more insight into what is causing it or what is making it appear different in the data. Would be, I suppose, my concluding comment to your comment.
Well, I'm going to follow you in social media to see if you ever end up advising people to invest in this as an asset class.
Oh no, I openly say that it's, as it sits today, given history, then no, because we know the directionality often. This is often down. It's just with the way that sport is emerging and evolving, I look at the exit strategies of private equity is invariably to go public. They have a 10-year time horizon on their funds. I know a lot of them are dumping themselves back into the same funds with new money. But what's the exit strategy is one of the things I kind of also look at is where is this money going to end up? Where's it going to go? And the sad part of it is, given the success of things like Formula One, it creates this narrative that we get involved, we improve it, we stick it on the market, everyone wins. I don't necessarily agree with that narrative, but that's sadly one that's going to start emerging given the success of things like Formula One.
But, and I'm not suggesting this is what you're doing, but isn't it the case that if you could persuade the markets, if I could persuade the markets that this is a separate asset class, then I could make money out of that, couldn't I? Just by being the conduit for this new asset class to go onto the markets. I presume there's lots of hoops you have to go through with the markets, and I would be the lead consultant on that, and they would pay me a fee for my work. So in some sense, there's a financial incentive to persuade people that this is a distinct asset class.
They're already kind of doing it anyway in their media offerings. Like if you just type in sport alternative asset class and any particular private equity, they're already bounding that it is. They're already saying that it provides all these aspects.
They're trying to get out, right?
Well, no, again, but the point being is that's the interesting part. It appears to some extent that it's true. Now, whether we agree with it or not, statistically, under a tangential portfolio, it improves it. It reduces risk. It's not priced by other factors. Now, again, we know that, say, private equity, real estate, bonds, and equities all have different interpretations of why you invest in them. You invest in bonds, you want the security of the known income. Obviously, the credit ratings allow us to insure. Equities for a bit more risk. Real estate, because we want to have that kind of economic growth with the property in the portfolio. They all have distinctive characteristics. From that perspective, sport does have a distinctive characteristic. Probably good.
But I thought you conceded that if we went back 3 decades, if you just extended the data, the series, actually this wouldn't fly, this wouldn't work because it wouldn't meet condition 3, right?
If we just looked at football clubs. But again, I haven't considered, again, I know Dennis mentioned there was a few clubs in America that, and under an equally weighted portfolio, the good ones may have outweighed the bad. The same as most portfolios, the good outweighs the bad. There could be enough good in sport, not just football, in sport, that there is a potential good out the bad.
Well, there are papers on that, and I think you need to look at those, because I think they actually know. The papers I've seen say no, the good doesn't outweigh the bad. The bad is so much bad, there really isn't any good.
Yeah. I want to ask another question that gets in the weeds of what you've done a little bit. When I think about the sport index, there's clubs from multiple countries. I'm curious what the relative proportion of companies from different countries, how it would compare with those other indices to your sport index.
So in each particular jurisdiction, it's very, very thin. So the UK, Celtic and United, and the US, you've got the Braves and MSGS. TKO is a global equity, essentially, because it covers UFC and WWE. Formula One would be a global equity. The Brisbane Broncos is Australia. Juventus in Italy, Dortmund in Germany. So each individual.
In your other indices, what would be the relative? So in the real estate investment trust,
I use a global one, and I use a global.
So what will be the proportion from England, and what would be the proportion from the US? Because it sounds like you might have 1 out of 21 in your sport. Yeah. Would you have that same sort of percentage in the others?
No, so in the globe, in like the real estate trust, it will often be kind of economically derived. The countries that are doing better, there'll be more assets in those jurisdictions, and then as you get to the lower economic countries, and obviously certain assets in that will be different. And it's the same with the bonds. The better bonds will be deriving from the US and Europe, and then obviously there'll be some weaker bonds in there that could be more speculative. That could be in different jurisdictions. That's why I tried using global proxies. But again, I
Okay,
know
and
what you're saying. If individually each area, it would obviously. Again, we looked at the Manchester United being the only one that shared similar return characteristics to the market. And again, Manchester United probably is the largest football team on the exchanges, so it's quite likely that that is a reason why it mirrors. And the more obscure clubs relative to the market are unknown. So therefore, it's less like they're going to move with the market anyway. But that's why I looked at it as just a portfolio approach. If all of these assets were in the portfolio from all sport on a global level, but again, at an individual level, yeah, you'll probably find, but you're only talking one club per jurisdiction, maybe two or three. So
yeah, I guess what I'm wondering about is, and I'm just making numbers up because I have no idea, but let's suppose that 20% of the real estate investment trust portfolio is based in the US and only 3% of your sports index is based in the US. I might think that the things that drive that real estate investment trust are going to be different than the sport simply because there's so much more diversity in where they're coming from than in the two situations, as opposed to there being any real. It's just the mixing problem, I guess.
and that's what the portfolios are about. When you look at diversification, you're supposed to blend everything together. That's the theory behind Markowitz's work, was you blend it all together, you take collective risk, and therefore you get collective benefit, but invariably under a portfolio theory approach. But I know what you're saying in the sense of, if you look at the economic drivers of the portfolio, you'll probably find, yeah, they're going to be limited to certain regions.
Okay.
And therefore the other regions are. But because, again, that makes it even thinner, I'll be looking at one company compared to one exchange or one market. It becomes an even more untenable conversation of, is sport the asset? So because it is so thin, only 21 companies going that granular. But in a pricing model, however, we probably could, if a pricing model was developed, then you could start to assess that thing of, well, how much of this one exposed to this particular market that it sits in. The pricing model would certainly be able to do that far better than this homogeneous diversified portfolio approach.
So then this is my last question, I think. Some of the studies that are on individual stocks in sport also look at the volume of transactions. And I wonder what your volume of transactions in your sport portfolio looks like relative to the volume of transactions in any of your other indices.
Yeah. Thin trading was one of the limitations I listed. So there is a thin trading in quite a few of the equities, especially those on the more obscure exchanges. Again, Formula One, Manchester United, TKO, so UFC blend with WWE, trades a lot more frequently, as does MSGS, relative to the other one. So again, that could be one of the reasons why. And it was one of the limitations I mentioned that could be changing that global view of, well, they're traded so thinly, where those on the ASCWI would trade much more frequently. So therefore, the price discovery mechanism is much more rapid in the higher trading volumes than in the non-trading, where price discovery becomes very, very difficult. And that difference could be manifesting in the differences we're seeing. But again, that's where a pricing model would certainly be able to provide more context on how much of that liquidity or that thin trading is driving the difference between what we're observing and what is driving it.
I do have one more question, or maybe this is a comment. Stefan gets a smile on his face. Yeah, he's always going to ask something. So I think back to Georg Stottmann's paper about Borussia Dortmund, and I don't recall if Dortmund was in your list or not.
Yeah.
And for the longest time, they never paid a dividend. But then, I don't know, within the last 10 years, for the first time ever, they paid dividends. I'm curious, of your other companies that are in here, how many of them have paid dividends?
So with the dividend side of things, it comes back to that expected return. So we look at, again, Berkshire Hathaway's never paid a dividend, but the expectation is going to keep growing in value. So therefore, investors sacrifice the dividend for that.
Okay.
In loss-making things like football, I think dividends are pretty much an impossibility. So therefore, they're looking at long-term growth as being the return provider. And again, in the indexes we use, ASCWI, there will be a blend of those that pay dividends frequently. So therefore, predictable dividends would be embedded in the share price. And then you have those that don't pay dividend. So therefore, that predictable non-dividend is embedded in the share price. So in a portfolio setting, that individual company decision is unlikely to have too much of an aspect. But in individual buying and selling, yeah, that becomes entirely important. But within the portfolio setting, unless it was an unexpected not payment of dividend or an unexpected payment of dividend, that would be the only thing that would really shift the market return on what they was expecting to happen.
This is always what makes me feel so incredibly old, is that, this is when I studied finance 40 years ago, the whole idea was that an asset value was based on the returns, the profits that it would generate at some point, maybe not soon, but eventually. And now that's just gone out the window. Assets don't have to make any profits ever. And isn't this really, I mean, shouldn't we just put this into the vibe class of assets? This should be in there with Bitcoin and meme stocks and the whole thing. That's what we're actually talking about here, isn't it? I mean,
It's
is that going to make any money? It's just Bitcoin, right?
Yeah, and I think that's sadly one of the things of this growth aspect. When people are looking at growth stocks, retaining earnings to grow, that's become one of these mantras that companies use to not pay. But there's going to be a kick the can down the road. We're going to get big though, and therefore we're looking at that momentum of we're going to grow in value eventually. Sport would certainly fit that narrative of the type of asset that it would be. Football clubs don't make profit, can't pay a dividend. But we're going to get good. We're going to get big. We're going to get to the Champions League, and we're going to win the league, and that will grow our value. I think that would certainly be the narrative there, if they list from private equity into public equity, would be that we don't expect a dividend, so therefore it's priced in, but we're going to grow. But
we've been through all this. We did it. We did this 30 years ago, and we know what happened. It used to be that it took 50, 60 years for people to repeat the mistakes of the past, but now it seems like it's only barely a decade that we need, and we're going to go through the whole thing again and screw up in exactly the same way. You saw it here first.
I think many things is going to be that, sadly, Stefan, and when we look at the recent history to modern history, so I think the repeatability is going to happen again.
Well, I just hope that in your paper you might at some point say this.
No,
again,
this out, it's very much a work of it. And again, I do stress the limitations. I do stress that this is not a return pricing thing. It's purely answering, does it meet those conditions to classify as an alternative asset? Whether it's a good alternative asset is a different conversation, but is it alternate enough from equities to bonds to real estate and to private equity? It appears so. And that's only the question. Again, I will certainly stress that in no way, shape or form is this go and pile your money into Manchester United, but more so along the lines of, if the narrative in the media and the market is it is alternative asset, is it? Well, it's distinct enough that it is. It's probably the way I'd end that comment on what the paper's supposed to serve.
Well, thank you very much, Stefan, Dennis, and Danny. I get to sit back and enjoy the conversation. My only question, Danny, is very, very superficial, which is, can you plot one of those nice little financial charts of your SCI like you would see for other?
It's in the paper. So on appendix there. So in the paper it's there, but it is present, and it does show positive returns. But again,
still back to the
not happy with positive return. But what it shows and what it is. But it's in the paper though, James. Yeah, there is a chart in there that shows relative to those other asset classes, what does it look like? Yeah,
and I guess also, you obviously send the paper to me. Is it online at all as well?
It's on SSRN.
Okay.
So it should be on there. If you just sport alternative asset class SSRN, it does come straight up.
Perfect. Well, thank you very much, Danny. We have taken up our full hour and a half. It's not usually half-hour discussion and full-hour discussion. It's a presentation and full-hour discussion. But these are the ways that things often work. So thank you very much for presenting what's a really interesting work in progress. I wish you all the best as you move forward with it. We will come back again next week. And next week we have David Perez Reina from the University of the Andes presenting the impact of tournament design on competitive fairness. So yeah, thanks everyone. Have a great weekend. See you all.
Thank you, Dennis. Thank
Bye,
you,
everyone.
James. Thank you, Stefan.
Cheers, Danny. Take
Bye-bye.
care, mate.